I'm Nick Hodge, as he said. This is money and mouth, where I'm putting them. I was at a loss as to what to talk about, so I decided just to talk about the overall macro picture, not just commodities, but you'll see stocks and economic growth as well, and then we'll get down into some of what I own. That's mainly what I write about, both in Foundational Profits and Hodge Family Office. Foundational Profits is a letter that I write about what I'm doing with my safe capital in IRAs. It recently took over for the Dines letter after he sadly passed away in early 2022. I've met some of his subscribers here already and at the VRIC that they had back in May. It's wonderful to see those folks and to hear that they're enjoying the letter. And then in Hodge Family Office, I talk about the speculations I'm making, and there's a private intel portion of that where I offer private placements that I'm writing checks into myself. And we can talk about some of those at the end. They just had one of these conferences 7 months ago or so. It was in May. It was delayed because of the ongoing pandemic, and so it's only been a half a year or so since I was on this stage, and I gave a talk that was titled then "Macro Bear Hungry for Golden Lollipop with Uranium Center," and the gist was essentially that slide you see on the screen there, that the cycle was about to turn. That black line that you see is corporate capex as a proportion of the S&P and what they were investing in, and it had been tech, and commodities had been going down, and obviously you want to sell at the bottom or buy commodities at the bottom of that chart. And my argument was that we were entering a bear market in the economy and stocks, and on the other side of that bear market, the bear would be hungry for gold and for uranium, and we're getting closer to that now. So I wanted to update that talk and talk about where we are in the commodity cycle, and I sort of put it on a chart there. That's a very long-term chart of the CRB Commodities Index. Goes back to when the last super cycle started in around 1994, and you see that super cycle lasted all the way until 2008, when it turned around and completed its basing in 2020 when the new super cycle kicked off. So I firmly believe we're in a bullish super cycle for commodities, though I think we're going to see fits and starts. I put there on the chart where I think we are. Trees don't grow to the sky. You pick your saying about that, but there's going to be pullbacks. There's going to be retracements, and I'm going to get into some of that and why. But that's where I think we are, a couple of years into a bullish commodity super cycle overall. This is what I want to convey over the next couple of slides, is that not all commodities are going to go up at the same time. They're not all going to go down at the same time. They don't move together. There's a lot of components of that CRB Commodities Index. A lot of the things that we like to invest in, specifically like uranium and lithium in the current market, aren't even in that index. So I'm going to get into parsing some of those out, and then I think you still have time to establish positions. Like I say, I think we're in the early stages of a commodity super cycle, and there's going to be pullbacks. So let's use this volatility. Let's use this coming recession that I'm going to talk about to establish your positions, to cap off the positions you've already established if you feel like you need to add more. Now's the time to start buying the dip, right? It was buy the dip in the overall indices for the past 10 years or so in a zero rate interest environment. Now that's inverted. It's time to sell the rips and the broader equities and buy the dips in commodities and precious metals. So everything went up, post COVID, during the stimulus checks, the Paycheck Protection Plan, when inflation was still transitory and everyone knew that it wasn't, everything was going up. You remember the charts of lumber and wheat or whatever it is. And then that sort of capped out in May of 2022, May of last year, perhaps a little bit later, as the market, Mr. Market, realized that recession was coming essentially, and that there was going to be demand destruction. And so if you look back, that's drilling into the CRB Commodity Index. You see it sort of peaking out to last May. It's in this sort of retracement that was on that broader slide that I put up earlier. And so what we're seeing now is divergence. Whereas, like I said, last year in late 2021, all commodities were ripping. Corn was ripping higher. Wheat was ripping higher. Oil certainly was ripping higher. It was literally negative, if you remember, and then screamed all the way to $120 a barrel. And what we've seen now since last fall is gold starting to tick higher. Well, what happened? You got a little softness in the dollar. The DXY ran all the way to well above 105 and is now started to pull back since last fall. But more importantly, the 10-year yield has started to come down a little bit, showing that the U.S. at least is going to enter a recession. And what happened when that 10-year started pulling back is that gold finally took off. That happened in late October, early November last year. And you'll see there on the chart, I just put coffee and hogs. There's a real divergence now because the softs are starting to go down, whereas everything was moving up together in the past year. And that's what I was just saying, why is that? It's because, a recession is here. And we had a sort of a mini recession last year, 2 consecutive quarters of negative GDP growth. I'll talk about that in a second. But we're not out of the woods. That yield curve, that's the U.S. 10-year yield minus the U.S. 2-year yield. It's still negative. It's the most negative it's been in 35 or so years, more negative than it was ahead of the dot-com crash even. And it's not relenting. It's staying negative, despite the current, bounce in broader equities that we've seen for the past couple of months, and the continued talk of soft landing, right? That soft landing talk is sort of like now what transitory talk was a year and a half ago. It's really not going to happen. And this is parsing out the rates. So the first arrow I put on there is when the yield curve first inverted. This is going back to early 2022 now. That was because the 2-year yield was moving up faster than the 10-year yield. That's the first arrow. And that was because the Fed was starting to hike rates, right? We were entering a rate hike cycle. Now that curve is widening out, it's getting more negative, but it's not because the 2-year is going up, which is the short end of the curve. That's what the Fed controls. That yield spread is widening because the 10-year, which is the candle chart, is going down now. And the Fed doesn't control the longer end of the curve. What controls that is, the economic future. The market is saying, there's going to be a recession. That's why the longer duration bond yields are falling now, whereas, they were going up lockstep for the second half of last year, as you can see on that chart. It tells me a slowdown is still coming. And the other thing is, the dollar has softened a bit, as I mentioned earlier, but really what was happening is there was almost a 1-to-1 inverse correlation with the dollar and gold. And what's happened since last November when gold started getting bullish is it started correlating more with the US 10-year, right? So if you look at that chart, what's a more inverse correlation there? It looks to me like it's correlating more, and not just looks, it is correlating more with the US 10-year yield than it is correlating inversely with the dollar. And I guess to drill that home a little bit more, it's good for gold, right? Because if gold is correlating less with the dollar, it means that even if the dollar can regain strength, which might happen as we enter this recession in the mid part of this year, gold can still go up in step with the rising dollar. It's something that I see happening. This is something not a lot of people talk about. There's not just the VIX of stocks. There's the volatility of other things. There's, the volatility of the NASDAQ, the volatility of individual commodities, the volatility of currencies, and this is the volatility of gold. You'll see that the wicks on those candles are getting much shorter, and it's consolidating much lower, right? Lower volatility on an asset class, specifically gold, is good. It means it's time to buy. It means investors are getting comfortable. It means the market is getting comfortable with where gold is heading, as opposed to that chart last year where there was a lot of volatility inside of the volatility. It's smoothing out. It's very good for gold. And then another thing I would say is gold stocks have some catching up to do really across the board. You know how bull markets work, the producers and royalty companies first, producers and then developers, prospect generators and explorers go. They haven't even caught up to the price of gold here yet. And we know that in a true gold bull market, they'll overshoot the underlying asset, right? Gold stocks will overshoot the gold price. And the line I put there in late 2015, that was the last time the Fed hiked rates. So, we hear a lot about, Fed hiking isn't good for gold. That's not necessarily the case. When they started hiking rates last time in December of 2015, you saw the gold complex take off very sharply. And I think you'll see that at some point over the next year or so. Where are we? Well, I've been writing about a double whammy recession in my letters, and you can see on the chart there, that's the seasonally adjusted quarter-over-quarter GDP annualized. We had 2 consecutive negative quarters of GDP last year. It was sort of a flash recession, a mini recession. And then in Q3, the economy was growing again, and Q4, it grew, but it's starting to slow down. We just got that 2.9% number last week, I believe it was. I think you're going to have, after this, in Q1 of 2023 and Q2 of 2023, you're going to have 2 more consecutive quarters of zero to negative growth. these numbers, certainly the 2.9% number that we got last week, were being buoyed by inventories, buoyed by imports, but not really growth in the economy, not housing, not construction, not the things that you need for an economy to really grow. And so people who are saying, stocks bottomed, I know memes are really popular. There's a lot of investors on Twitter these days, and I feel left out if I don't put at least one on there. So, this soft landing, the stocks are going up. It's like, yes, but the trend is still down. The growth is still contracting or slowing down. The S&P is still in a bear market. The Fed still is going to hike at least another 50 basis points. You'll get a hike here this week in the next couple of days. I don't know if it's going to be 25 or 50 basis points, but we're not out of this hiking cycle yet. And the broader indices, the S&P 500 is not growing. So in last quarter, Q4 2022, it still had positive earnings growth. This quarter and likely in the next quarter, you're going to see negative earnings growth. So that's all 11 sectors of the S&P 500 with the S&P right in the middle there. And you'll see that as of today, I think today was January 27th or something when I grabbed that slide, you're looking at, negative 5% earnings growth across all of the S&P. In the past couple of quarters, that growth was positive because it was being driven by oil prices and oil earnings, which are still good. I'm sure you saw, Chevron's earnings last week, record earnings, large buybacks. That's still happening, but the not as fast, right? It's not $120 oil, it's $80 oil now. And that even energy, the fastest growing sector there, the highest earnings growth, it's not going to be enough to make the S&P earnings growth positive. And that's going to lead to a retracement, I think, in the S&P and put it back in this bear market. We've had these bear market rallies. We had one, in March last year. We had one again in June. And this one has been going since October. But each time it sort of fails at its trend line. And I don't believe we're out of the woods yet. There's the rate hikes that are still coming. That's the expectations for future rate hikes. You're at 4.25% to 4.5% now. This chart's saying they're not going to top out until you get over 5%. That means at least 2 more quarter percentage point hikes or another half percentage point hike. I'm not sure how that'll play out, but I do believe that rates go to 5% terminally before they turn back around, which isn't expected until like late 2023, early 2024. And that's your window, I think, that I was saying. Use this coming volatility in the economy, this coming volatility in the overall equities to establish and build your positions in these resource stocks. The other thing that a lot of people are talking about is the money supply, the rate of change in the money supply. It's negative, It's not just rate hiking, it's quantitative tightening. They're taking $95 billion a month out of the economy, the Fed is, and they're pretty serious about it. So that chart only went to 1985 on the Fed website, but that's the first time the rate of change of money growth has gone negative since 1960. There's less liquidity out there. There's less money sloshing around. It's a tightening. And this is a slide about how recessions play out, the sectors of the market that it affects. I've showed this in the past couple talks I've given over the past year, and it's funny how we've moved through it. Housing was the first one to get affected, and then new orders, ISM surveys, manufacturing orders, things like that. That's all been affected. And I was just talking about profits, this earnings recession that we're in, this contracting earnings growth in the S&P. That's the third leg to fall there. And then the thing that hasn't been affected, and the reason the Fed can continue hiking, is that the employment hasn't been affected, right? There's still literally no unemployment. Once that unemployment starts to tick up, and you're seeing whispers of it in these tech layoffs, that'll give the Fed cover to finally do this pivot that I've said wasn't coming, and people have insisted it was coming for the past 12 months. There's no pivot. They're going to take these rates to 5%. There's going to be a recession, and then it's going to metastasize or catalyze with unemployment, and that's going to happen over the next, I think, 6 to 12 months. Sorry for all the text. You're going to have to read for a second. I'll do it for you. I think flat to negative GDP growth over the next couple of quarters, which would make it a recession. I think that would add to the tailwind for gold that's already going up because of falling rates, because you're going to get capital rotation out of broader indices that aren't going up, that are still in a bear market, into gold, which is going up. I think that tailwind for gold could prove a headwind for other commodities, especially copper. Copper's come up strong. Went to $5 last year, fell all the way back down closer to $3, and is now back over $4. But I think you get time over the next 6 months during this recession. It's Dr. Copper, right? I call it the world's general practitioner there. Copper can't go up if you've got the U.S. in a recession. It was going up from the China reopening and things that are now starting to fade a little bit. That's not to say I'm bearish on copper. That's just to say it's not going to go straight up for the next 6 months, and you have time to establish quality positions. So that was all CRB stuff, commodities and currencies that are in the CRB. I'll talk about lithium and uranium briefly, uranium very briefly, because I'm on 2 uranium panels tomorrow, and we'll beat it to death then. But these are commodities that I'm saying are immune from this recession, pretty much because of supply and demand fundamentals. So this slide is from Benchmark, and Simon Moores is here. You should go listen to him speak at some point if you have the opportunity. Is saying that lithium production this year globally is going to increase 42% year over year, and it's still not going to be enough to have a surplus. The lithium market is still going to be in a deficit, even though global production is going to grow 42% this year. And it's not going to get any better for a while. This is a slide from Albemarle, one of the largest lithium producers in the world, that just came out this last week. They updated guidance, and they say, look, by 2030, there's going to be an 800,000 ton deficit. To put that in perspective, 800,000 tons is what the world is going to produce this year. So in 7 years, there's going to be a shortage of the current global entire supply of lithium. And that's going to keep prices materially high, which is what Albemarle was saying. So by 2030, you're going to need to find all the current production in the world to make up that deficit. And I don't see it happening. So that's lithium, and it's the same story in uranium. Look, you got 120 million pounds of U3O8 production, and you've got 90 million pounds of demand, and that doesn't take into account secondary demand, like the Sprott Physical Trust that's buying. There's just a material shortage. That's the delta there between the top of the vertical bars and the gray shading. That's going to last for a while and might rectify itself in 2027 or so, but then just gets worse after that. So, and there's a lot of other reasons to be bullish on uranium right now that lots of other speakers will talk about. I'll mention just a couple. It's switching from underfeeding to overfeeding because of troubles with Russia. Essentially, there's not a lot of Western capacity for enrichment and conversion, and instead of putting in less and getting out more, you're going to have to put in more to get out the same amount. That's one big reason that the demand could be higher than anyone is currently thinking. Contracting is coming back in a big way. The utilities are stepping up to start buying. 2023 is a contracting year. That secondary demand I mentioned, the UECs, the yellow cakes of the world buying physical. And then small modular reactors, which are coming on, very fast in terms of, regulatory approval. We just got the first design approved in the U.S., and it's going to be another source of demand for uranium. And that's a bullish chart for sure. It's consolidating very nicely at 50 and doesn't need to move up much higher to break out and head to 60 in a hurry. I've got less than a minute, so I know Rick Rule always says when I'm on the panels, they don't want to know how to fish. They want the fish served to them filleted and served with the appropriate accoutrement. So I break things out into levels of risk and duration. The top couple of lines there I write about in a monthly letter. They're things I own in my IRA, GLD, GDXJ, the Sprott Uranium Fund, URNM. And I go through the allocations, how much I own, et cetera, in the letter. And then down to producers and royalty companies. Nailed the bottom of Triple Flag recently, bought that in December, and have ridden that up over 20% already, like Franco-Nevada, like MP Materials, which didn't mention rare earths in this talk, but very bullish on Western supply and refinement processing of rare earths. Could have thrown Energy Fuels on that slide too. Developers I like, Revival Gold, that's RVG, 4 million ounces in Idaho. Past producing, has all the infrastructure. Critical Elements there is CRE, the most recently approved lithium project here in Canada, in Quebec. An NPV of hundreds of millions of dollars, close to $1 billion, while it trades at just a couple of $100 million market cap. Like Bravo, they have a project called Luanga that Vale drilled out down in Brazil, has A robust PGM resource has some nickel, has a lot of rhodium that wasn't included in the previous resource, and is on to some new nickel and copper sulfide discoveries. They want me to go fast now. RHC is a Royal Helium. Didn't talk about helium, but very bullish. Cucho Copper is KC. And then you have to write down the other tickers because I'm out of time. And I have to mention before I get off the stage, those last two, PMET and Q2, I should mention that I have a partner named Gerardo Del Real who writes resource-exclusive newsletters. And PMET is Patriot Battery Metals. Some people may be familiar. He financed that company at 16 cents. I followed him in at 34 cents. That's a stock that's trading, at $12.50 inside of a year and a half. So very bullish on lithium, bullish on uranium. Sorry I'm out of time. Come to the uranium talks tomorrow. I hope to see you on the sidelines.